Hello and welcome to today's webinar. Thank you all for joining us. I'm Alex Bazarewski, partner and head of America's coverage for Rede Partners. I'm joined today by two senior members of our transactions team, Mike Camacho and Max Barnes. As many of you know, Rede's transactions team is on the forefront of advising GPs on a variety of liquidity solutions. Today's topic is on NAV financing, as we believe this is increasingly one of the most important tools in the GP liquidity solution toolkit. As you may know, Rede has been very active in the NAV financing space as it has reemerged and has worked on nearly $7 billion of NAV financing since 2020, including several landmark deals that set the precedent for the market. Over the next 30 minutes, we'll provide you with an introduction to NAV financing, discuss various implementations, and also touch on the latest market trends. We'll reserve 15 minutes at the end for live Q&A. If you'd like to submit a question, please feel free to do so through the Q&A button in the bottom ribbon of your Zoom window. With that, I'll turn it over to Mike and Max.
Thanks, Alex. Pleasure to be here. Around the same time last year, we delivered a similar webinar to approximately 250 participants. And we started off with the words, NAV financing is just being discovered by many private equity sponsors. 1 year later, it is more appropriate to say, NAV financing is a well-established tool that many sponsors have used, and sponsors would be doing themselves a disservice if not considering it to solve for a number of objectives. Many of the same objectives that can be accomplished with equity can also be accomplished with debt. Continuation funds or top-up co-investment funds are not the only way to raise additional capital, nor is an exit the only way to generate liquidity. Furthermore, there are advantages to applying leverage at the portfolio versus company level, namely cost, covenants, and PIK interest versus cash, among others. Used effectively and in the right situations, they can be yet another powerful tool in sponsors' toolkits, which is why we have seen many brand name PE houses approaching the NAV financing market in the last 12 months. As with any new development in private equity, sponsors, LPs, portfolio companies, and other participants in the PE ecosystem have a lot of questions and perhaps even skepticism, which we will aim to address, demystify, and importantly, inform you as a sponsor to allow you to best consider whether a NAV financing would be an appropriate solution for your fund/portfolio. We will also touch upon how to execute an NAV financing, a NAV financing, and what to expect when you approach the market. Over to you, Max.
Thank you very much, Mike and Alex, and a big thank you from me to everyone who has joined the call today. As part of the preparation for this webinar, we have completed a market study that surveyed a number of the leading participants in the NAV financing space, which we thought would be a good way to set the scene for some of this presentation. As you may have already experienced, the world of NAV financing is pretty opaque, but we hope the data we have collected, sprinkled with some anecdotal evidence from Rede, will help provide a bit more clarity and evidence to the trends that we're observing in the market. We'll be diving into some of the results from the survey as we go through this masterclass today. Next slide, please. So I'd first like to talk a little bit about the trajectory of the NAV financing market. Now, we estimate this is well over a 20 billion euro or $20 billion market in terms of deals actually completed in the NAV financing space globally. Our survey results show that the total number of deals or the volume of deals has risen over the last year. In fact, on average, each lender saw 21 deals come across their desk in 2022, and that's up from an average of 16 deals per lender in the previous year. Maybe taking a step back here and putting this into some context, looking at the capital markets more broadly, leveraged loan issuance in the US was down 24% in 2022 versus 21, and US high yield market suffered an even steeper decline, dropping 78%. In contrast, our survey results show that 83% of lenders reported an increase in the number of NAV transaction opportunities over the last year. Now, this increase in deal flow is pretty striking in that context of the wider macro environment, and we feel really helps highlight the underlying momentum that is building in this segment. We believe NAV financing transactions are becoming more widely recognized, more understood, and this technology has now become a really important alternative source of liquidity in a much tougher exit environment that we are experiencing. Back to you, Mike.
Thank you, Max. We have borrowed this graph from the team at 17 Capital, who expect that the adoption curve for NAV financing will follow the same for sublines and GP-led transactions, the latter of which saw 50% of GPs having tapped the GP-led market by the end of 2021. While not a very mature market, the NAV financing market is what we would describe as firmly established, with a healthy ecosystem of borrowers, i.e. sponsors, lenders, consisting of a mix of banks, credit funds, and parties that you would traditionally think of as limited partners, lawyers, and advisors who are increasingly specializing in this highly bespoke and solution-oriented market. As Rede has advised close to $7 billion of transactions since the inception of our practice, we can confidently say that no two transactions are alike, not even remotely. There are typically at least 10 or more key commercial items and 10 or more key legal questions that are relevant in selecting an NAV facility to pursue. To be clear, that's 10 or more commercial terms and 10 or more key legal terms as well. We believe that this highly bespoke approach to each transaction is what has driven the growth of the NAV financing market to date and will continue to drive adoption to 2030, when it is expected that we will reach 80% market adoption. Clearly, brand name sponsors, such as the ones you see at the bottom of the screen, are helping push the market forward. And we expect that when we revisit this chart in 12 months, we'll be further up the curve and with many more logos to show. Next slide, please. NAV financing facilities are the second most popular type of fund financing, although admittedly a far second to subscription lines, or sublines for short, which are ubiquitous as we saw on the last page. Whereas sublines are backed by the LP's committed capital and are used as a fund is drawn, a NAV loan needs some assets to back, and those assets must have some history. Therefore, NAV loans are typically done after at least 2/3 of a fund is invested, and there's evidence of value creation in the portfolio, the V in LTV. The greater the V or value, naturally the greater the quantum of an NAV loan is possible. We have seen NAV loans executed as late as year 10 of a fund life, in order to further invest in the portfolio when calling capital from LPs is no longer possible. These are an interesting alternative to a continuation fund, and naturally does not all involve the transfer of assets to a new vehicle nor any transfer price determination. It's important to note that NAV lines are not an alternative to sublines, rather they are complements implemented later in the life of the fund and can coexist alongside with the subline as they look to different collateral, sublines, LP commitments, NAV lines to the portfolio. Those NAV facilities executed to improve DPI and enhance IRR, which are akin to dividend recaps, are often most effective when completed approaching the end of the investment period of the fund and the beginning of the harvesting period. Conversely, those NAV facilities done to provide for additional capital for portfolio companies are often done beyond the investment period, when calling capital from LPs is no longer possible. Next slide, please. There are several objectives that a NAV financing can help achieve and several advantages versus other solutions. We've listed out a few on this page. Using a NAV facility can lead to IRR improvement. For example, if a distribution is accelerated, that brings eventual payback of a fund forward, improving IRR. This can help achieve certain fund return objectives earlier, like bringing DPI above 1x, which buys patience for the fund to allow the strongest assets to be held for longer and to generate more value in the form of higher cash-on-cash returns for the fund. These distributions sometimes create recallable capital, which can be recycled into portfolio companies, increasing the firepower of the fund, thus achieving multiple objectives simultaneously. Compared to individual portfolio company refinancings, NAV facilities are an efficient way to generate a sizable distribution without burdening the companies with direct debt obligations or lengthy due diligence periods. Think of about 2 to 3 months to execute a NAV financing on a portfolio, compared to 3 to 4 months per portfolio company, times however many portfolio companies you have are in a portfolio. Next slide, and back to Max.
Thanks, Mike. So here I'd like to discuss the options out there for sponsors in terms of security and structure. Essentially, GPs have two options. They can go down a secured route or a more recourse-light unsecured option. Let me first describe the secured option. Much like asset-level financing, these loans are fully secured against the underlying assets in the portfolio. There are multiple ways to structure that security to help work within the regulatory or tax or perhaps covenant constraints that may already exist, whether that's security over the top cos, the equity shares themselves, or perhaps an aggregator. The most likely lender for these type of facilities are banks, as they are more accustomed to operating in the lower risk return spectrum. But it's worth noting that not all banks do think the same, and there are a few names out there that can be quite flexible in terms of the security package. Now, one of the key questions we do get asked a lot by our clients is what happens in an event of default or if it goes wrong. Firstly, there is usually an extended grace period of about 12 months when GPs can attempt to remedy that default scenario. So perhaps the LTV has crept up too high, they can pay down some of the loan within that time frame. If this grace period expires, however, well then in a secured facility, the lender is able to step in and sell some of the assets to repay themselves in full. For this level of security, the borrower will naturally be able to attract a much lower cost of capital, and here we are talking mid to low single-digit margins. So what does an unsecured facility look like, or a recourse-light structure? Here, the lender has no pledge over the assets in the portfolio, which means that in an event of default, and even if that 12-month grace period does expire, the lender is not able to step in and sell any of the underlying assets. They simply have to wait for any realization proceeds to come back from the fund or the portfolio when, and crucially here, when the GP decides to sell those underlying companies. The more sort of natural lender, I guess, for these type of facilities are credit funds or alternative lenders. But it's worth noting again that some banks can offer this solution too. Both structures have their own benefits and downsides. A secured solution offers a more attractive cost of capital, whereas an unsecured solution offers peace of mind and the ability for sponsors to message to their LPs that the lenders have no rights over the assets. I'll pass back to you, Mike.
Thank you. We wanted to take this opportunity to address a few common concerns we hear voiced about NAV financings to arm you with the information you need to be well-versed in this topic. The first concern is that it's just adding leverage upon leverage. Lenders and borrowers alike are very careful about adding leverage to already levered portfolios. Rather than a NAV facility being additional leverage, it is often an alternative to portfolio company refinancings with benefits with respect to overall costs and flexibility. The second common concern that we hear is that cross-collateralization of assets is dangerous. First of all, we wanted to say somewhat skeptically that there is already a strong interrelationship between assets within a fund because a sponsor is motivated to produce a good outcome at a fund level. So if one asset were to underperform, a sponsor would likely aim to seek outperformance from another asset. But specifically related to a NAV financing and the cross-collateralization that by definition ensues as a result, yes, this can be dangerous when used irresponsibly, but at LTV levels of 25% or lower, and with default covenant levels that allow the portfolio to deteriorate by 30 to 50% before a default occurs, which is what we observe in completed facilities, we consider the risk to be remote. On the flip side, when sponsors seek an unsecured facility, many lenders worry they are powerless, can only sit there and wait for the sponsor to solve the issue. While the documentation may indeed imply that, the truth is that sponsors are quite motivated to make sure that their funds are a success, and a default of any fund level facility would be a disaster scenario for them. We believe quality sponsors would make a good faith effort to solve any issues with the NAV financing, as they first and foremost are looking to protect their funds, LPs, performance, reputation, and ultimately their business. We see that the most successful NAV lending parties or lenders understand this dynamic very well. They see it as an underwriting of the GP's franchise rather than a hard trade. Naturally, cost of capital, it's no secret that cost of capital has risen across all asset classes, and the NAV financing market is no different. Nonetheless, portfolio financing often represents a cheaper alternative to asset level financing alternatives. In our view, the cost of capital for NAV financing has also risen less than its often touted equity alternatives. Max will discuss this in further detail on the next slide, in a further slide. More broadly, Rede does not see the proliferation of NAV facilities as a good or bad thing in and of itself. We see it as a tool that, when used effectively and responsibly, can achieve various objectives and make sense for all involved stakeholders. On balance, we see that attractive sponsors in today's market have been able to negotiate very LP-friendly terms, and that the transactions make sense for sponsors, LPs, and lenders alike. So let's dive into some typical terms on the next slide, please. So opening LTV, or loan to value, that's expressed as a percentage. It's one of the most important factors in a NAV financing, ranges widely depending upon the use of proceeds. The opening LTV informs the opening margin, covenant levels, and ratchets that impact what a borrower will pay throughout the life of a facility. This is a key point of any facility, and it's akin to turns of EBITDA leverage in an asset level financing. Generally, we don't see these exceeding 25%. Above 25%, you get more into the preferred equity territory, which is outside of the content of this presentation today. Size-wise, they really can be any size, but institutional lenders are rarely interested below $25 million, and some of the larger facilities we've seen are around the $1 billion mark. Above 500 million, and this typically requires a club of lenders. Margins, they can vary quite significantly depending upon LTV, security, term, portfolio, and sponsor quality. But we do see that most of these get done at a base rate of plus 4% to 10%, base rate plus 4% to 10%, with ratchets upwards and downwards depending upon how LTV develops. PIK, or payments in kind, is often a key feature in this market, although we have seen that recently some lenders tried to limit the number of periods during which the option to PIK is available. Upfront fees are important for lenders to help them make their overall returns. They're typically at least 1%, often structured as an original issue discount. Commitment fees on undrawn are also applicable. The term of these loans is anywhere from 3 to 5 years, with extensions typically at the discretion of the lender and often subject to a fee. Banks tend to be more sensitive than credit funds on longer duration facilities. Cash sweep, that's an important element of any facility, and that governs who gets what cash and when. Sponsors, lenders, and advisors have really notched up the creativity in coming up with all sorts of cash sharing schemes. Importantly, LPs are less and less likely to just be relegated to the back of the bus when it comes to distributions. Sponsors are almost always able to negotiate that LPs and lenders share in the cash flows from the beginning to the end of the life of the facility. Lastly, covenants, those typically relate to things like concentration of the portfolio, the number of assets remaining in the portfolio above X million dollars in value, for example, an LTV. And often that LTV bar moves down as the portfolio becomes smaller due to exits. Next slide, please, and back to Max.
Thanks, Mike. Now, we cannot deny that a lot of the deal negotiations ultimately come down to pricing. And I'm sure it's a question on many of your minds today, where is that pricing level at? Now, the overall cost of NAV facilities have risen in the last 12 months, but not as much as you might have expected. In fact, much of the all-in cost increase has been due to the sharp rise in base rates rather than margins themselves increasing. So since March 2022, Base rates have been rising to combat the rising inflation stemming from COVID-19 crisis, supply chain issues, and the conflict in Ukraine. We've seen Euribor rise over 350 basis points, and SOFR has increased over 450 basis points. Now, most of these NAV loans are structured as floating rate loans, so a rising base rate does directly impact the all-in cost of capital. But where are margins trending? Well, 76% of lenders surveyed raised pricing less than 200 basis points in 2022. The weighted average increase was around 140 basis points, while 6% of lenders actually lowered their margins. We feel this is a pretty modest increase and is likely due to the additional return that lenders are gaining from the rising base rates, despite the additional risk perceived in the market. Now, our survey results show that lenders' target margins continue to hover around that 8% mark. This figure we feel is somewhat artificially high compared to the deals we have managed to secure for our GPs over the last 2 years or so. But this is mainly because our survey does encompass lenders all up and down the LTV and risk return spectrum. So you have some higher returning credit funds in that too. There may also be some self-reporting bias here as well. We see pricing for a diversified, strong performing buyout portfolio at maybe a sub 20% LTV, trading well below that 8% margin, particularly for a secured deal. Compare this with asset level financing, the mid-single digits or so that we're able to achieve on a NAV facility are certainly an attractive option for GPs considering refinancing, liquidity solutions, or add-on investments. Back to you, Mike.
Thanks, Max. Yes, so one question we often field is, how quickly can these get done? If structured and executed well by experienced parties, these can be done start to finish in as little as 10 weeks or 2 months and change. That is including prep time as well. What we see with NAV financing is that the bulk materials are off the shelf, particularly if the sponsor has recently raised their fund or is currently fundraising. This is quite favorable compared to the amount of preparation needed for a GP-led transaction where third-party DD reports are increasingly common. Furthermore, lenders are accustomed to moving very fast and can often respond to a term sheet in 2 to 3 weeks. They are also accustomed to being resourceful and executing due diligence in an expedited and relatively painless fashion. Comparing again to the GP-led market, a fast GP-led transaction would be executed in 4 months and more likely 5 to 6 months. Next slide, please. As a sponsor, you need to ask pointed questions to your lender suitors. We've laid out a few suggestions on this page. In our humble opinion, these questions revolve around 3 key themes. Can you meet my objectives? What are your motivations? And how will our relationship look like going forward? Firstly, it's important to understand whether there is a meeting of the minds between you and the lender, and that manifests itself in being able to deliver the best possible terms of the facility. What is important to you must be important to them, and what they seek must also be acceptable to you as a borrower, naturally. Execution track record is, of course, very important. As a relatively new asset class, there are fewer lenders with a longer track record than in, for example, the leveraged finance space, naturally. Nonetheless, we would focus on the number and volume of facilities that a lender group has executed from start to finish. If they have lead executed 3 or more transactions, we would consider them to already be quite experienced in this market. Can you underwrite the transaction? This is particularly relevant for large transactions above $500 million. Not many lenders will want to hold $500 million plus on their books, but some can and will provide the transaction certainty that underwriting affords. Lastly, what is the actual source of your funding? Is it discretionary funds, balance sheets, capital? Is it co-investors that you would involve or key relationships in the insurance sector? It's important to understand what are the approval processes for those ultimate sources of capital. It's also important, moving to the second column, to understand the lenders and the key professionals within those lender groups' objectives. Broadly speaking, the approval process at banks and credit funds differ. Banks need approval from risk and credit committees, and they stretch for an opportunity if they believe there's a benefit from a total relationship perspective, i.e. fees. Credit funds tend to think more on a relative basis and tend to lean in and out of the space based on how else they can deploy their capital. We would encourage you to probe on an individual's KPIs. So are they motivated by profit and loss, or are they motivated by carried interest? Is it close to their financial year end for the lender? Is the credit fund in the beginning of its fund life or at the end of its fund life? Understanding this well can give you the upper hand in negotiations and drive optimal outcomes. And once a transaction is complete, what do the next few years look like together? Will you plan on holding what you take down or syndicating it to other banks or lenders? Who will manage this loan going forward at the lender's organization? And what if things go wrong? We know what happens on paper. That's all documented, of course. But how flexible and constructive is the organization? Can you expect that dialogue to be? We believe it's important to address all of these questions well before you sign on the dotted line. Back to Max.
Thanks, Mike. So how important are sponsor and lender relationships? Well, there are probably 75 lenders in this space. Now, some certainly more active than others. And our survey results showed that 61% of lenders are looking further afield from their current client base when considering NAV deals. Now, we have built up a pretty strong network within this universe, which is important when it comes down to the negotiations and dealing with lenders on the other side of the table, but also crucially important in introducing new lender relationships to GPs. There is no doubt that an existing relationship does count for something. Existing lenders, they know the manager, they know the assets already, which give them a bit of a head start in the DD process. As well as this, existing relationships become particularly important when we enter into a syndication process. In some of these larger facilities, often several lenders will make up a consortium of term takers behind one lead lender. Sponsors will naturally favor the existing relationships over parties they have not worked with before when it comes down to allocation. But at the end of the day, when we run these processes for sponsors, it is the best offer on the table that wins, and GPs should actively consider broadening their lender base with new names. I'll now pass back to Mike for some concluding remarks.
Yes, thank you, Max. So the growth in this space has been driven by its ability to help sponsors manage their portfolio and fund performance. The macroeconomic backdrop and the slowdown in exits have shifted attention towards the NAV financing space as an alternative to so-called normal exits, continuation funds, portco level recaps, or additional equity funding. The fact that these transactions can be executed in as little as 2 months also helps make the case for NAV financing in a market where longer lead times equals increased execution risk. This is a deep market with many new players popping out of the woodwork. 23 has seen an increase on 22, 22 on 21. The ability to lever a high quality, diversified portfolio and have strong franchise alignment with high quality sponsors is a key attraction for lenders and bringing more and more to the market. The high demand for this product also allows sponsors to craft bespoke transactions and get favorable terms for the funds and their limited partners. Speaking of limited partners or LPs, many have already plenty of experience with that NAV financings in their own portfolio or in their private equity portfolio, and will expect high quality sponsors to have a base level of knowledge of the market. They will expect the sponsor to have considered this when bringing any proposal to the table. Likewise, being well prepared to approach the market with the help of experienced advisors will allow a sponsor to negotiate the best possible transaction that fulfills its objectives. Lastly, the NAV financing technology is not just limited to private equity funds. The same technology can be applied to management company financing, so-called GP financing, to individual partners financing of GP commitments and fund of funds. Thank you. Alex?
Great. Well, that concludes our prepared remarks today. Really appreciate, again, everyone joining us. Hope this was helpful. We've included our contact information here on the slide. As always, Rede wants to be a resource, so don't be shy. Please reach out, questions. If you want to go deeper on any of the subjects, we're here to help. We do, as I mentioned at the outset, we do have a bit of time reserved for some of the questions that we got during the session. And just as a reminder for those of you who haven't submitted a question, if you'd like to, you can do so sort of on the bottom ribbon of your Zoom window. But I guess to kick it off, Mike, I will ask you the first question, which is, why do you say the market is growing when actually the market declined in 22?
Yeah, it's a good question. So you're right. We estimate that the market declined about 12.5% in 22 versus 21. Nonetheless, the number of transactions increased and the adoption from sponsors is at an all-time high. Given the overall market development in 2022, we would say that the slight decline is actually a net positive sign for the NAV financing industry. Notably, there was also one particularly large deal in 2021, which makes 2021 a hard comparable. So stripped of that deal, one can say that 2022 actually grew over 2021.
Great, thank you. I guess, Max, I'll give you the next one, which is the very simple, why should a GP use an advisor on a NAV financing?
Thanks, Alex. Another good question. Hopefully we've touched on this a little bit today in our presentation, but I think there's a few reasons why having an advisor or intermediary on these processes make a lot of sense. One is, as I talked to earlier, around introductions and approaching the right counterparties. This is an ever-expanding universe. There are more and more lenders coming online every year. I think we've been introduced ourselves to another sort of 15 to 20 only in the last 12 months or so. So the ability for us to make those introductions to sponsors, I think, is important. As well as that, having a view on the market, where terms are sort of bottoming out, where the market precedents are, and also the ability to drive, optimize and drive those terms to a sponsor-friendly solution, but one that also works for all parties, is important as well. And having an intermediary in place can do that. And then lastly, and I think this relates a bit to the continuation fund world as well, having an arm's length process where we can run a competitive process, that's a helpful message to show to sponsors, LPs, that they've truly market tested.
That makes a lot of sense. Thanks, Max. And I guess actually maybe I'll give you a sort of follow on to that, which is, and Max or Mike, please feel free to answer, but are LPs made aware when GPs take on additional leverage? Do they have veto rights? What does that look like?
Mike, did you want to take this one?
Yeah, sure, I can. It depends. There are sometimes, in any case, we always advise and recommend for strong communication with your LPs. That's just a given. And the franchise that Rede has is built upon that strong communication between sponsors and their limited partners. The question is whether or not there is approval that is needed. We see that is actually changing over time. So new funds that are being raised today, their LPAs are more generous around these provisions. One, because they see that it's a more well-established market. The older funds just really didn't contemplate them. And so in those situations, often the LPAC is informed and it often is LPAC approval. We have also seen that in some situations, there's been full LP approval. I think that's probably more rare, but that is also possible. I think also once something is put in place, we would say that sponsors should continue to report on how that loan is performing, the LTV, what interest rate is currently being paid, etc. So yes, to the broader question of whether or not there is sort of a veto right or not, yeah, it just depends, I would say. But again, more communication with LP, the more communication, the better. It is naturally a more mature space than it was 1 year ago, but still not something that absolutely every LP will have experience with today.
Okay. Thanks, Mike. The next question is, I guess, Max, have you seen banks and non-banks sort of combine to provide Term A, Term B NAV facilities? And maybe just give the audience a bit of context about what that actually means.
Sure, certainly. And again, it relates a little bit to what we described earlier around banks wanting to operate in maybe the lower risk return spectrum versus credit funds who are willing to take on a little bit more risk. And perhaps in larger facilities where you may need more than one party to take down the full amount, banks and lenders or alternative lenders can come together with the bank taking a first out or first lien on the underlying portfolio, on the assets, on the security package, with the alternative credit lenders taking the second, which means, again, in a sort of default scenario where the cash flows will sweep to, the bank has priority. And I think this is a really interesting trend that we're observing in the market. It shows that the market is becoming more sophisticated. I would say the majority of deals today often get done without this in place. But I think we will only see a rise in this trend going forward. And yeah, that would be my take on that.
Right. Thanks, Max. Mike, the next one is, how can GPs borrow at rates well above the hurdle rate?
Yeah, it's fair question. The higher interest rate environment naturally forces harder questions upon sponsors and LPs alike, and they need to reconsider what tools they use in managing their portfolios. Overall, we would say that the modest increase in overall returns sought by lenders in this space, and therefore the borrower's cost of capital, is attractive relative to its alternatives. Put plainly, the equity cost of capital has risen more than the NAV financing cost of capital has risen. It is, of course, but naturally every situation needs to be determined. The models need to be produced, and the upside and the downside scenarios need to be considered. But often we do find that sponsors are thinking that it is still interesting despite not always being able to borrow below the 8% all-in cost of capital.
Great, thank you. The next one is, how often do NAV facilities get credit ratings?
I'm happy to take this one. So credit ratings, again, I'd say often is the answer. Most of the facilities that we have sort of helped run have been rated at some point. Now, it's important to know that these ratings are private; they are not sort of public, and they're very much done on a bilateral basis between the sponsor with a little bit of input and the lender and the credit rating agency. It is often rated at the back end, and what I mean by that is after the transaction has closed. And crucially, it allows lenders who have taken down or who have underwritten a large facility to syndicate out some of their some of those sort of that quantum, that amount, to maybe the US insurance market, for example. It does help in cases to get it rated before the transaction closes. This can help lower or reduce the cost of capital. However, with that, you might disrupt the process. It might take a little bit longer. So there's a bit of a balance, a tick for tack there with the two.
That makes sense. Great. I guess the next question is, where does the US NAV market stand sort of relative to its European and APAC counterparts?
Yeah, sure. So we've seen that the first movers have come from the European market, but we see that the US market is catching up quickly. Why is that? Broadly speaking, some more restrictions on borrowing in US fund LPAs, also some more complications with respect to a tax perspective, ECIs, etc., sort of all come to mind. But again, I think that is changing quite rapidly. And actually, a lot of the large NAV financing markets that we saw in 2022 actually happened with more US sort of oriented sponsors or global sponsors with operating from their US office. The APAC market is yet unproven to date, although there are a few transactions that we can point to that have indeed happened in the APAC market.
That's helpful. Next question is, I guess, about sort of incentives and ultimately, do GPs get sort of faster into the carry through the use of NAV facilities? Yeah,
I'll take that one. One could argue that is the case with any exit that happens to push the GP into carried interest. So you could ask, why would you sell that asset now and sacrifice the upside? Are you maximizing price or just thinking about accelerated carry? As with any decision that a sponsor makes regarding its fund, the investment must be considered in light of the risk and reward opportunity, and then the opportunity cost as well. In the case of a NAV facility to distribute proceeds, the LP should question what level of additional risk the sponsor is taking on, and what is the cost of that financing, and how will it benefit the fund returns in a base case scenario, and then also naturally act in an upside and then in a downside scenario. We find that the assertion of GPs only executing NAV financings for dividend recaps just to accelerate carry, it's too simplistic. We'd urge LPs to think more about the benefits and advantages versus other liquidity events. In fact, a NAV financing can help enhance all fund return metrics, so not just IRR, but also DPI, MOIC, so the LPs also win.
Got it. Thank you for that. The next question is, are these NAV facilities purely for sort of direct into underlying assets on the LP vehicles? Or are there options out there to finance sort of like the GP carry portion?
Yeah, well, they're typically, I'll take that, that's okay. So they typically are used to finance all of the assets, which therefore then flows through the waterfall, and then by definition does finance the GP portion, the GP carried interest and also the GP commitment. But there's also the opportunity to take that collateral, that being GP's carried interest, and finance that independently, naturally depending upon what else is also being pledged at the same time. So all of that is possible. If there's something that you can claim against, it's possible to lever against it. So yes, it absolutely is possible.
Thank you. What are the key terms and KPIs that GPs use to evaluate a NAV financing facility?
Yeah, it's a good question. I guess maybe answering this from the key terms perspective and how to evaluate a NAV financing facility. As we said, pricing is going to be key there, but GPs should also consider a number of other economic factors as well. You've got an upfront fee that's important to put into your calculations. Your margin may increase as LTV increases, etc. So again, you may have to run that model as well, and that's something that an advisor can help with. You should look at, for example, if it's for DPI purposes, again, you can model in that distribution back to your LPs. How is that helpful? Or as Mike has alluded to, if it's for using those proceeds to invest in new add-on investments, again, that can all be taken into account. So I think there are a number of key KPIs there that they should look at and evaluate. But these term sheets are complex and they can get quite long, especially when you reach long form documentation. So it's worth spending some time analyzing all the offers that come in sort of piece by piece. We often say that the devil is in the detail.
Always is. Well, good. And so I'm watching the clock. We've got just a little bit more time. So I think we probably have time for one or two more questions. Mike, maybe I'll direct the next one to you, which is, have you seen NAV lines structured as borrowing-based revolving credit facilities rather than term loans?
They're mostly term loans, I would say. Everything we've worked on has been a term loan, if I recall correctly. RCFs, you'll need to consider, you'll have a much lower sort of commitment to the facility because naturally it can be redrawn. Now, there's ways around this. Naturally, you can seek a higher level facility and you can also extend the availability period. And of course, at that point, you would be paying more there. But generally, it's more fashioned as individual term loans. And there's also sort of limits as to how little you can draw typically and how many times you can draw. So most banks do not want you to divide a $100 million loan into 100 different $1 million loans or 200 different 500K loans.
Great. All right. Final question, I promise. We put you two through the ringer. But I guess the final question we'll ask today is, are NAV facilities exclusively for sort of LBO type strategies, or are they applicable to growth managers, private debt managers? Would love thoughts on that.
Yeah, it's a good question, and the answer is no, not necessarily. In fact, we did run a process, I believe, in 2021 with a venture manager, and that actually makes a lot of sense when you are collateralizing a whole pool of venture assets. You're certainly able to achieve a pretty good cost of capital versus individual venture capital debt at each of the asset levels. So no, it's certainly not just for sort of LBO buyout type funds. And I'd say, in fact, that within private credit funds, this technology has been in existence and around for a much longer time, and they're able to go much further up the LTV spectrum. I think that's probably fair, is it, Mike?
Yeah, no, indeed. Yeah, it sort of started with sort of private credit funds, actually, really. And it makes sense because they pay cash, so you can sort of service at the portfolio level. It makes sense to try to use that engineering and that technology to be able to enhance returns. And yeah, we've worked on venture and growth facilities in the past. It's one of the few ways. Of course, there is venture debt, and there's a few providers of that. But on the NAV financing side, we saw a lot of demand actually for that financing of that venture capital portfolio, which we was a relative. I don't want to say it was a first, but was relatively innovative.
Yeah, great. Well, I think that concludes the Q&A session. Again, thank you everybody for joining, for the thoughtful questions. I know we didn't get to all of them, so again, please don't be shy. You know how to reach us, and we would be delighted to spend more time with you discussing not only NAV facilities, but certainly NAV facilities and other sort of solutions. So thank you again, and we hope to speak with you all soon.